Here is the most believed financial myth in America: buying a home is a great investment. It builds equity. It is better than throwing money away on rent. Your home will always go up in value. These statements are so deeply embedded in the culture that questioning them feels almost un-American. But when you run the actual numbers, the full numbers, including every cost, the case for homeownership as an investment vehicle is much weaker than the culture suggests. I am not telling you not to buy a home. I am telling you to understand what you are actually buying, what it actually costs, and what the honest return is, so you make the decision with accurate information rather than mythology. Robert Shiller is a Nobel Prize-winning economist at Yale. He spent years constructing the most comprehensive dataset of American home prices ever assembled, going back to 1890. His data is in his book Irrational Exuberance, and it has been cited in more housing research than almost any other source. The finding is stark. From 1890 to 2012, over 120 years, inflation-adjusted home prices in the United States rose an average of 0.6% per year. Not 6%. 0.6%. After accounting for inflation, the real purchasing power return of American real estate over more than a century was essentially flat. There are periods of strong appreciation: the 2000s housing boom, the post-2012 recovery, the pandemic-era surge. But these are followed by corrections, stagnation, and decades of flatness. The long run is brutally clear. For comparison, the S&P 500 has returned approximately 7% per year after inflation over the same long-term period. Inflation-adjusted bonds return roughly 2 to 3%. Cash return approximately 0% after inflation. Real estate, 0.6%. Now, this does not mean your specific home will return 0.6%. You might live in a market that significantly outperforms the national average. San Francisco, Austin, and Miami have seen dramatic appreciation over specific periods. But buying a home in an outperforming market requires correctly predicting which markets will outperform, which is timing the market by a different name. The 0.6% real return calculation is before ownership costs. When you layer in the actual cost structure of homeownership, the math gets considerably worse. Let us use a $400,000 home as our example and calculate the annual ownership costs beyond the mortgage principal. Mortgage interest, at 6.5% on a $320,000 loan, 80% financed, interest cost in year one is approximately $20,800. This is money you pay and do not get back. It is the equivalent of rent on the money you borrowed. Property taxes, 1 to 2% of value annually depending on location. On a $400,000 home, let us use 1.25%. That is $5,000 per year, escalating as your home's assessed value increases. Insurance. Homeowners insurance averages $1,500 to $2,500 per year depending on location and coverage. Use $2,000. Maintenance and repairs. The 1 to 2% of home value rule is standard among financial planners. On a $400,000 home, budget $4,000 to $8,000 per year. Some years it is zero. Some years the furnace fails and the roof leaks simultaneously and you spend $25,000. The average across time is reliably 1 to 2%. Total recurring annual costs excluding mortgage principal, roughly $31,000 to $35,000 on a $400,000 home. That is $2,600 to $3,000 per month going out the door that builds zero equity. Then there are transaction costs. Buying a home typically costs 2 to 5% in closing costs. Selling costs 6 to 8% in agent commissions, transfer taxes, and closing fees. If you buy and sell a $400,000 home, you pay roughly $36,000 to $52,000 in transaction costs alone. These are sunk costs that reduce your effective return on every transaction. The most overlooked cost of homeownership is the opportunity cost of the down payment. To buy that $400,000 home, you need approximately $80,000 down, 20%, plus $8,000 to $15,000 in closing costs. Call it $90,000 to $95,000 in upfront capital. That capital, if invested in the S&P 500 at a 10% annual return instead, grows to $233,000 in 10 years. $604,000 in 20 years. $1.56 million in 30 years. Meanwhile, your home at 0.6% real annual appreciation goes from $400,000 to approximately $424,000 in 10 years in real terms, before all carrying costs. The opportunity cost of the down payment is a real cost. It does not show up on your mortgage statement. It does not feel like a cost because you never see the money leave. But it is economic reality. Capital deployed in one place cannot be deployed somewhere else, and the difference in returns between the two options is the true opportunity cost. None of this means renting forever is the optimal choice. There are specific conditions under which buying a home is clearly the correct financial and life decision. First, time horizon. The New York Times Rent versus Buy calculator, which you should run for your specific situation, consistently shows that buying makes more sense the longer you plan to stay. Transaction costs are fixed. The longer you hold, the more those costs are amortized across years of ownership. In most markets, the break-even point, where buying beats renting financially, is 5 to 7 years of ownership. If you plan to stay less than 5 years, renting almost always wins mathematically. Second, stable market, reasonable price-to-rent ratio. The price-to-rent ratio divides the home price by annual rent for a comparable property. A ratio below 15 favors buying. A ratio above 20 generally favors renting. Many coastal cities have price-to-rent ratios of 30 to 50, meaning the math heavily favors renting. Midwest and Sun Belt cities often have ratios of 12 to 18, where buying makes more financial sense. Third, rate environment matters. At 3% mortgage rates, the interest cost of borrowing is low enough that the rent versus buy math shifts significantly toward buying. At 6 and 7% rates, renting becomes more competitive in most markets because the interest cost is high. Fourth, life stability. The non-financial benefits of ownership, stability, schools, customization, community, are real and valuable. These do not show up in a return calculation, but they are legitimate factors in a decision that is as much about life quality as it is about wealth building. Let us address the building equity argument directly, because it is the most common justification for homeownership as an investment. Yes, you build equity as you pay down the mortgage and if the property appreciates. But equity is illiquid. You cannot spend it without selling the home or borrowing against it through a HELOC or cash-out refinance. Both of those options have costs and risks. The comparison people make is rent versus mortgage payment, and they say the mortgage payment builds equity while rent disappears. That is partially true, but incomplete. In year one of a $320,000 mortgage at 6.5%, only $3,240 of your annual payments go to principal. The remaining $20,800 goes to interest, which is economically equivalent to rent on the borrowed money. You are effectively paying $20,800 per year in rent to the bank plus $5,000 in property taxes plus $2,000 in insurance plus $4,000 in maintenance. That is $31,800 in money that does not build equity. The honest comparison is total housing cost of ownership versus total housing cost of renting, not mortgage payment versus rent. When you make that comparison and add the opportunity cost of the down payment, the financial case for owning is much less obvious than the culture suggests. Here is the decision framework to use when evaluating rent versus buy. First, run the New York Times rent versus buy calculator with your specific numbers. It is free and uses a sophisticated model that includes all relevant costs. Second, check the price-to-rent ratio in your target market. Divide the purchase price of the home you are considering by the annual rent of a comparable property. Above 20, renting likely wins. Below 15, buying likely wins. Between 15 and 20, it depends on your time horizon. Third, assess your time horizon honestly. If there is more than a 30% chance you move in the next 5 years due to career, family, or lifestyle reasons, renting is probably the financially superior choice. Fourth, evaluate the non-financial factors separately and explicitly. Stability, schools, belonging, customization, these are legitimate values. Just account for them as what they are, lifestyle purchases, not investment returns. Your home can be a wonderful place to live and a valuable asset, just not primarily an investment vehicle. The expected real financial return of homeownership is modest, the costs are substantial, and the illiquidity is real. Owning with accurate expectations leads to better financial decisions than owning with mythology. Word count, 1, 300 duration, 10-minute end card, next video, dividend investing, the truth behind the $5,000 per month dream.